I don't recall if either of the council members that I can see on my screen right now were on the finance committee or on council in 2017. No, okay. This might be a little new, but it does tie nicely to the work that we've previously done. So it is an independent review of Neighborhood 5. But there's quite a bit of logical consistency and I think parity between all the neighborhoods, which is something that isn't sort of a fait accompli, but it's very, very nice that we see it in the analysis here because it's certainly intuitive. So Cindy, next slide. For the council members, his first introduction to me. So Nate Perez, I'm a managing director. I run a Northern California practice out of San Jose. Currently out of my home right now, as is with most of us these days. DTA's been providing fiscal impact services to agencies across California and the Western United States since 1985. I've done well over 150 at this point. I'm a recovering land use attorney. I'm a municipal advisor registered with the SEC. We have a lot of multidisciplinary ways we approach projects at DTA. In the audience with me should be Chris Nadiak of my staff and Kyle Martinez of my staff who helped me with this. And Chris has had a long history of working with the city of San Ramon as well. So next slide. Okay, great. Well, so folks who this may be a little bit new, might have seen it in another project, another life, and another career. Really, the goal of a fiscal impact study is to make sure that the project's sort of paying its own way. It sounds simple, but like with anything, it can become a little bit complex. But really, it's to make sure that the revenue generated, typically via property tax and sales taxes, is offsetting the cost of the operations and maintenance, the city staffing, the overhead associated with, in this case, Neighborhood 5 of the Faria Preserve. The goal when we do this has different sort of nomenclature in different communities, but sort of no net expense. It's not that the project doesn't have an expense, it's that the revenues associated with the project are offsetting those expenses. You hear the term fiscal neutrality a lot. In the report, you see a couple ratios. I think you guys can sort of intuitively understand. A 1.00 ratio would be fiscally neutral. Anything in excess of that would be you'd essentially be getting more revenue from the project. Anything below 1.0 would suggest that there's a gap that needs to be mitigated, that there's a shortfall, and that's what's present here. And thus, there's a strategy to cure that gap. So next slide, please. What a fiscal impact study is not. And, I just referenced this because sometimes, I work in land use and a lot of questions and concerns and anxieties get poured into these documents. So I think the flavor of the month right now is the HCD regional housing needs allocations. We're seeing a lot of that getting discussed. It's related certainly, but, this is sort of not per se a city budget document or a city funding strategy. In essence, what we've done is for logical ease, we've put a dome over Neighborhood 5, and we've evaluated the revenues and expenditures, sort of occurring under that dome. The fiscal impact study itself is not a mitigation strategy. It just identifies either a surplus or a shortfall. And in this case, again, it's a shortfall. But we will discuss the various mitigation strategies, which, as Cindy noted, is annexation into the CFD, which neighborhoods 1 through 4 have already been subject to. Next slide, please. So again, this may be super simple. I don't want to be too short, too long. It's always a bit hard to gauge virtually how engaged folks are. But the primer would be revenues versus costs. I think is the biggest threshold issue. The biggest source of costs in any city in California are typically going to be public safety costs and things of that nature, public works, quality of life costs, parks, rec, things. And then on the revenue side, typically property tax and sales taxes. This is a residential neighborhood for the most part. There's a small site designated for a house of worship, I believe, or at least zoned for a house of worship. So, we're not really generating sales taxes or TOT. within neighborhood 5. There probably going to be a couple COVID questions a little bit later. So, to some extent, is a little bit insulated from the COVID discussion because the nature of the land use that's occurring here. That being said, nothing's really insulated from that discussion. Whether it's revenues or expenditures, there's two ways you really evaluate a project in California. And one is a multiplier path, and the other is a case study approach. I'll begin with the case study approach because it's a little bit more intuitive. Think of it as interviews. Think of it as outreach with the police chief, with the head of the library department. What do we really think it's going to cost? Is there something unique about your project and unique about needing a police substation? There's a lot of outreach, perhaps with an individual department head, and looking at their cost structure. The more simple path is a multiplier approach. There's sort of a bunch of text here and a sort of a graph on the next page, but I'm not in love with it. The multiplier approach is essentially if you're expecting a 10% growth in your city population, most of your cost centers should increase by 10%. And so, the idea is that you split certain costs and revenues into different buckets. Some are under a case study approach, but the vast majority under a multiplier approach. That population growth is really the key metric that you're evaluating. 5% growth in population, most likely a 5% growth in, for instance, your park fees and things of that nature. Excuse me, not your park impact fees, but your user fees for park rentals and things of that nature. So next slide, please, Cindy. This is we show this graphically because a lot of folks see a fiscal impact analysis and they see all the appendices with the really tiny font at the back, and there's a little bit of confusion. But if you do track this mathematically from the top where it says sample population of 100,000, if you add 500 new folks to that population, what is that? That's 1/2 of 1% increase. And so that's why we see that fiscal impact occurring of $5,000, because roughly if we have that increase in the population, we're going to see that increase in the vast majority of our revenue and cost centers. Here we pick fines and forfeitures, franchise fees, and licenses and permits. These are things that would be difficult to evaluate under a case study method, but also aren't driving the bulk of the revenue in a roughly 160 unit neighborhood. That will be the property tax haul. So next slide, please. So why are we just looking at operations and maintenance? That's a big question too. This fiscal is sort of a snapshot, revenues versus expenditures for the projected build out in sort of fiscal year 21. The reason we do this is, one, we have to come up with a strategy, of course. Number two is, the capital improvements associated with the project are considered to be one time. We believe that those, or we hope that those will be covered by your development agreement, your conditions of approval, your impact fees for your other agencies, the county, the school district that might be serving the site. And that the idea is that the general fund is perhaps the most sensitive of all funds. Water funds, sewer funds, enterprise funds have a little bit more of an ability to self-correct. I think the general fund is sort of subject to as we've seen with COVID, the world and California due to Prop 13 and various taxing restrictions. It can be difficult to fix. It can be difficult to write. So we at DTA believe sort of an analysis of that general fund is sort of the most conservative approach. And thus we sort of strip out that capital discussion. Now, can a capital element be infused into this? Yes, but based on the impact fees and the development agreement for the site, we felt that we were in pretty good shape there. So next slide. So effects of COVID. This is sort of the beginning and end and everything, of course, as it should be. The study was made final, designated final in November of 2020. It was using the fiscal year 1920 adopted budget. We have gone through and we've done a sensitivity analysis of sort of the changing parameters, and we don't believe that it would have been significant to update it. I had this conversation with Cindy and with other city staff. DTA would be happy to. It would just be an expense for the city and the developer that I didn't believe was really, really critical. The sales tax and TOT in the city, as they are in every city, are struggling, but we're also seeing an increase in housing prices as well. So there's sort of these counter pressures. And given the fact that neighborhood 5 is really just 162 residential units, I think 40 single family, about 122 condos. a 5% increase in prices. And we've seen that in the success with the incredible success of neighborhoods 1 through 4 and those resale prices. That in DTA's opinion sort of offsets, would offset any sort of COVID adjustments. And again, or not again, because I haven't stated it, we do believe there will be some equalization and some stabilization as we move through the rest of this year, and things will quote unquote return to normal. I know that won't happen immediately, but we were reluctant to make any big swings or big adjustments when we felt that some of the pressures might be offsetting. So next slide, please. We have evaluated it. There tend to not be perfect answers in the COVID space because I don't have a crystal ball, but I think there has been strong movement in housing prices in sort of really outside of where I live in San Jose, where it's going down, but everyone else seems to be benefiting, which I'm quite happy about. And this is a property tax driven project. The revenues from this project are almost all property tax revenues. There are no sales. This is not as though there's a boutique hotel in neighborhood 5 that is not generating expected revenues. So you can see the forecast a little bit in the bottom right as well. So next slide, please. And this part gets a little bit more wonkish, but in the expenditures, because we're offsetting revenues versus expenditures, we evaluate some specific infrastructure costs via a case study method, and that's where we actually look at the parks that are going in the ground in FREA neighborhood 5. We don't just sort of take the average park cost per person, because the park amenities there are fantastic. So what we've looked at is specifically the roadway, the street lights, the landscape medians, and the park acreage, not only in neighborhood 5, but that it was sort of shared with the previous neighborhoods because it is such a nice community. We work with our own internal database, and we work with your public works department to sort of cost those out. So those real park costs, at least as real as they can be, are included in the expenditure tab for FREA. So in essence, the project that's already embedded in the project must carry those. And so to full fiscal neutrality would include carrying those park maintenance costs. So next slide, please. And I think this slide 11, is sort of a continuation. There's about 2.84 acres of community parks across neighborhood 5. Park maintenance in California is expensive. Water, utility, landscaping costs, things of that nature, especially in a drought. We wanted to make sure that the city was well covered to protect those amenities because they drive a lot of those increased housing prices. So it's definitely, I think, something the development community wants as well. Next slide, please. So conclusions, we could have led with this, but this finance committee, and I want to give everyone the opportunity to hone their fiscal chops. But fiscal neutrality, no net expense. That's what we're trying to achieve. The table at the bottom is sort of a little bit unclear because it's aggregated across the project. This would sort of be neighborhood 5 as a whole. If you divided by 162, you would get sort of per unit quantities. But you can see that ratio, that 0.71 ratio, the idea being that for every dollar spent on the project by the city, we're only returning about 71 cents in revenue. And this is mostly via increased property taxes. This is a common theme. It can sort of be overused, and I think I'll just leave it at that, overused in California. This concept of the fiscalization of land use, that residential tends to not be fiscally neutral and that sales tax generating uses tend to be fiscally neutral. I will fully admit that there's with COVID, some of these things have been turned on their head. But we do know with the cost structures in the city and with the park maintenance and the infrastructure maintenance that this is going to be fiscally negative. And so there's a gap. There's that 29 basis point gap, that 29 percentage point gap, if you will, that needs to be closed. Next slide, please. So mitigation options, right? So I think we're talking about the fiscal, and I think the finance committee needs to review that and appreciate that. But sort of also the main question is what happens next. Is the general fund gap needs to be mitigated. There's a requirement in the condition of approval, that's very, very common. I mean, this is a very, very common tool. I don't know, we've probably done, probably 80 services CFDs in the last 2 years. It's becoming really a critical part of California finance. But the city was really ahead of the game in 2014 or 2013 and set up 2014-1 for public facilities and services to mitigate that shortfall, to figure out an annual revenue stream to cure that. And essentially what we've done is we've taken that gap, that per unit gap, and that becomes our starting point. That becomes our initial year. It's called a special tax because a community facilities district, I'm sure you guys are familiar with assessments and landscaping and lighting districts, things of that nature. This would be a community facilities district special tax, which the city is going to collect on the county tax bills and which it's going to be able to use to defray some of those costs. Here we see the carryover, the negative $110,000, which is the aggregate sum, which is that $681 per residential unit. This would be a maximum tax. The city doesn't necessarily per se have to charge this in any given year, but it would be within its discretion. To be honest, most cities typically do. The sum will also escalate because it's in 2021 dollars, and your current CFD structure does escalate, has an escalator built in. And you can also see, because I believe, I think I was very happy to see this, and I think it's a very critical point. The neighborhood 1 through 4, when we did this in 2017, 2018, began with sort of a mitigation figure of $692. So I think that parity is very strong for your neighborhood, for your communication to your residents and voters. I think is also really critical. So we were pleased with that. Next slide. I believe we're coming to the end first, so open up for questions. These are just pie charts, but I do like them because here secured property tax is the blue, property tax in lieu of VLF. It's a little hard to see is the purple, another 13%. So you're already at 57%, and throw in transfer taxes, throw in unsecured property taxes. Yeah, you're probably 60% for property taxes, franchise fees, add in a small component, but it really is a property tax focused development, as you would expect. And then I think the expenditure should be on the next slide, Cindy, I think. Yep. And this is pretty common. Police and public works, fire's done sort of separate agency with you guys, but if it were folded in, we would see that here. And then that infrastructure maintenance and that park maintenance, essentially being a supplement to public works to keep the project as amenitized as it is. Every project's different, every city's different, but so I don't want to say common, but I think the themes here and the takeaways here, there is a lot of consistency with what occurred in neighborhoods 1 through 4, and a lot of principles you would see in other communities as far as what's driving revenues, what's driving expenditures, and then that gap ultimately that needs to be sort of mitigated in some way. So I believe that's it. Cindy, there might be a Q&A. There we go. But folks have any and all questions, please.
Do we take questions from the public right now, or do we just have a discussion here? Christina?
You can, as a committee, you can take questions if you have for the consultant or staff, and then open it up for public comment.
Okay. Sounds good. Sridhar, do you have any questions? Councilmember Burrows.
Thank you. Thanks, Sabina. I have a couple of questions. First question is regarding the deficit here. We are saying like around 29%, if I remember right. Yeah. So most of the revenues that we are seeing here is the expected is that from the property taxes, especially the Ferrier Preserve. We don't have retail, we don't have any other services as such. So I'm surprised like how, and we know that the property values are going up. And I'm just a little surprised how the deficit came up in this very huge deficit. Like, maybe I'm missing some point here. So could you please give some clarification on that?
Certainly. I actually, I think if I were sort of graph this against peer cities, I think it's pretty common that residential development, short of incredibly luxury, large estate homes, runs a deficit. I'm perhaps sort of in the $4 to $5 million range. I think the big issue there, and as you guys are aware, and your finance staff is aware, the property taxes, I believe you guys get about 6% of 1%. So in San Ramon, and that's just such a small cut that yes, property tax assessed values are in a good place, but what actually flows through to the city itself, the city's general fund, just doesn't arm you with the tools. So I would say this is a pretty typical result for a residential only project. and that you would typically see a commercial component included or embedded somehow to get over that threshold.
So is that means that initial assessment that we did, was it wrong that we got into this situation?
No. I mean, I think I mean, the initial assessment is a function of your general fund, and I think the general funds struggle themselves to be fiscally neutral, and a lot of tough staffing decisions go into that. And the idea is that you don't want the new project to be a source to create any further degradation of the level of service. And if the project's highly amenitized, it's going to require that city services, public works, landscape maintenance really come in at sort of 2020 levels rather than sort of legacy underfunded levels. And that really drives a lot of the cost and keeps them pretty high in excess of what a normal per unit property tax haul would be. It also gives you the opportunity really with this to sort of reset. Prop 13 depresses that property tax haul in California and creates a situation where you don't have an opportunity to revisit it because you're only really, except for transfers and sales, you're only seeing that 2% growth in property taxes every year. Mm-hmm. This CFD structure, by evaluating each project independently, it really allows you to refresh, reset, and sort of, ensure mitigation in current dollars. And that's really the goal here. But I think it's the amenities largely from a project like this. I think if it weren't so nice, if there weren't the parkland, if it wasn't the project it is, I think we would see a much closer ratio.
Thank you. And the next question is regarding the CFD. Just for my understanding, is this development is the taxes that are going to the county, and then like similar to our Doughty Valley, are we going to get back from the county, or is it like this development directly going to pay the taxes to the county, and then is it like a special district?
Yes. Yeah. So if you guys are familiar with sort of landscape and lighting districts, and I think I saw Lauren somewhere as well, but this will get enrolled on the consolidated property tax bill for the county as a separate line item. And in addition, and that money will get routed through the county and then back out to you guys on their annual apportionment schedule. And Contra Costa is teetered, so it will be pretty consistent, and you guys will have that revenue stream consistently for Neighborhood 5 moving forward, which will allow you to, I think, plan and to maintain the project the way you want to maintain it.
Okay, sounds good. Thank you.
You're welcome.
So Nate, all those tax dollars are going to come to San Ramon, right? Because of the CFD.
Yes. Yeah. That's exactly it. I mean, I think the CFD, why it's, I don't like engage in sort of interagency politics too much, but I mean, it's how you keep it local. It's how agency, it doesn't go to Sacramento. It doesn't go to the county and go into some property tax sharing agreement like sales tax might. It will be collected by the county, but it is yours. And, I won't say bank on it, but it will be a pretty reliable revenue stream given the quality of the project and the fact that the county is teetered.
So it makes us whole where we see the deficit, and so we can take care of all those services.
Absolutely.
Is the plan to basically bundle it in with 1 through 4 and all 5 neighborhoods having the same CFD? I may have missed that. I wasn't sure.
No.
Or this will have its own.
That's a great question. So I think practically at the end of the day, it's going to feel as though they're all in the same CFD. Technically, this will be a new annexation to the CFD. Neighborhoods 1 through 4 was the first annexation. This will be the second annexation. So there will sort of be a different starting date, and there was a different fiscal analysis that became the justification for the mitigation amount. But as I noted, the amounts were very, very close. And then once all rolled up, it will feel like one whole CFD. And I think we'll be able to be managed as such. The rate structure will be slightly different, which will frustrate Lauren and his team, just ever so slightly. You just have to remember that. But I think it also is important because it demonstrates that the city is sort of reevaluating as you go, rather than using old numbers, which can be stale. I don't think they're stale here. But you see situations where folks say, oh, well, we'll just use the $600 number from 10 years ago, and it might not reflect anything that's unique about the project or unique about the budget. So yeah, I think the city's really doing a fantastic job by evaluating it with fresh eyes, but the sort of synchronicity between the two annexations is really close. So $690 and $680. It's very, very close.
I'm just thinking of neighbors that are going to talk to each other across the street.
You're
paying $10 less.
Yeah. Well, I think that, we've seen situations where, something happens, someone gets a grant, a park gets funded through an HOA or something like that, and maybe isn't public, and all of a sudden you see these big gaps. So it didn't guide what we did. Tail's not wagging the dog here, but it's certainly nice that there is that parity, because folks do talk, and we administer hundreds, if not thousands, of special districts across the United States. So we are well versed in getting those phone calls from property owners that my neighbor pays this, I pay this. Can you explain that? I think here it's just, small variations in timing, small variations in budget, really, and small variations in housing price and things like that.
And this next question might be for Cindy. How frequently do we reevaluate the CFDs, or, do they remain static, or do we increase, as time goes by?
Sure. So I think, and Nate may have briefly gone over this in his slides, but we do, and there's an annual adjustment to the rate. And so we have on an annual basis before that tax rate goes to the county, and at the close of the fiscal year, we get a new evaluation of how much that has increased for the upcoming year. And so there is an adjustment that's made.
Precisely, yeah. And in addition, these are maximum special taxes, in very much the same sense as impact fees. The council can choose to charge less. It can't charge more once this is set in stone, because there's a bit of a timing issue. It sort of has to be developed sort of at final map typically. So, I have seen folks we saw it a lot in 2008, 2009, rolling back services districts and things like that. A lot of times it's a function of housing prices and the housing economy, the local housing economy. This has been an incredible shock. This, just an unbelievable year-long recession. But it is different than the real estate generated and fed and destructive recession of 2008, 2009, where we were seeing housing prices drop 10%, 20%, if not more, 40% in certain communities. So, my sense is that I think the CFD will sort of be implemented if the council chooses, of course, and it will sort of, perhaps just climb up a little bit every year, but all the discretion will remain with you annually.
Thank you.
You're welcome.
I am good with questions. If there's any public comment, should we go to that, Christina?
Mm-hmm. For those in the audience that would like to make a comment on this item, please use the raise your hand button at this time. Does not appear we have any hands raised.
Right, so we close public comment then?
Yes.
All right, we close public comment, and Cindy, you're looking for a recommendation to send this to the council from us?
That's right.
Yeah. So
need to move them.
Right.
Sorry.
Do you want to move it? Go ahead if you want to move it.
Okay, so I move the motion for item number, let me take the number.
5.1?
5.1, yeah. So give me 1 minute.
It's on page 3, I had to scroll.
Okay, sorry. So I move the motion for the draft, but then for recommendation, staff recommends that finance committee review the staff report and forward to city council. Sorry, give me 1 minute. The subdivision and discussion. Okay, so I move the motion for item 5.1.
To move to City Council?
To the city.
I can second.
And then I'll do just a roll call. Vice Chair Veros.
Yes.
And Chair Zafar.
Yes.
Thank you. That motion passes 2-0.
Thank you. Thank you so much, Nate.
Thank you so much, council members, and thank you, Cindy, for all your help.
Thank you.
Have a great meeting. Take care. Bye.
You too. Thanks. Bye. So 5.2, City of San Ramon Quarterly Investment Report for period ending December 31st, 2020 by Candace Daniel, Finance Division Manager.
Good afternoon, everyone. You should have before you the quarterly investment report for the period ending December 31st, 2020. State law requires that the City Council review the quarterly investment report, at least on a quarterly basis. It's prepared, the portfolio is prepared by FHN Financial, which is our investment advisors. And the investments held by trustees are prepared by the trustee. So the balance of our city's bank account, which is at JP Morgan Chase on December 31st was 12.9 million, which is used for daily city operations. The total of the portfolio with FHN Financial was 65.4 million, which consisted of 45 million in federal agency securities, 2 million in treasury securities, 3.7 million in commercial paper, 8 million in corporate notes, 5.2 million in FDIC insured CDs, and 1.5 million in municipal bonds. The weighted average yield to maturity on the investments was 1.54%, and the weighted average days to maturity were 686 days, which was 56 days longer than the previous quarter. Interest rates were 12 basis points lower than the previous quarter. The city has a money market account, which is with Union Bank. At December 31st, we had 3.4 million available, which was 4.74% of the entire portfolio. That interest rate was 0.01%. And that's also available for cash needs on a daily basis. The city had 3.6 million, which was invested with LAIF. The interest rate on that was 0.52%, which makes up 4.93% of the total portfolio. And that is also available for immediate cash if needed. The investments held with trustees totaled 11.2 million. The 2019 certificates of participation were the majority of that total, which is designated for capital projects. The total of that was 10.3 million. And then we had 900,000 invested with other trustees for general purposes. Are there any questions?
Councilmember Veros, do you have questions?
Regarding these interest rates, like are we restricted for as a city investment, are we restricted to only going with certain level of risk level? Is that the reason we go with such a lower interest rate options?
Are you talking about for LAIF and for the money market?
Yeah.
Well, the money market, we just put some funds in there just so that if we need money in between the times that we get our large payments of property tax or sales tax. Mm-hmm. And then LAIF is the same thing. Actually, the LAIF interest rate is a lot higher, but we just have it there in case we need money and we can get it quickly. And then we put the rest in investments in the portfolio.
Okay.
Did that answer your question?
Yes, that sounds good. Thank you.
Okay.
But sorry, just follow-up question to that is, do we have any restrictions which says that, hey, you can go only with certain, only with the money market, or not specific to why we have this here, but do we have such restriction? I'm just wondering.
Yes, we have an investment policy that's posted on our website. It's updated every year, and we update it with comments from our investment advisors. So they have to follow the investment policy with where they actually put our investments. we have to be in compliance month to month.
Sounds good. So in order to be compliant, so perfect. Thank you.
Candace, is that compliance based on the risk level as, as kind of the keeper of public funds? Is that kind of, I'm new to this, so I'm trying to understand as well how this works.
The main thing in the investment policy is to just preserve the funds, not necessarily to try to get the highest dollar amount that we can in yield. We want to take the lowest risk that we can and preserve our funds. And then we have certain time frames that we can have investments in. It might be 2 years, it might be up to 5 years for certain investments. So they just have to keep all of our investments month to month within the policy. And we have a certain amount that we can keep in life as well, so that we stay in compliance with the policy.
I might add, there's certain parameters governments can invest in. We can't just go out as a government invest in anything in the stock market. So there's parameters, and then the finance committee reviews it. I think is it annually, Candace, where with our actual investors who give us this portfolio that has a kind of a conservative risk portfolio, kind of middle of the road risk portfolio, and then something that's a little bit more aggressive, but still within the parameters of what we can invest in. And then the council makes a decision based on that. And that's how we operate with our investment portfolio.
Yeah, that makes sense. I know where Councilmember Rose is coming from as well. He's like, the market is doing really well.
A lot of banks are doing that right now, right?
Yeah,
so banks, they are losing because of the interest rate, but then they're making all the money out of trades. If you see recent JP Morgan Chase, they're, my God, they're like doubled in their income while the interest market.
It's always good when they're making money, but for government, we're a little risk adverse. And so when those tables turn, the taxpayer doesn't get very happy when we start losing big bucks too. So that's why there's some parameters and some risk assessments on them.
Oh yeah, there are some cities which became bankrupt in 2008, right? Because they put a lot of risk investments. But then when I see like 0.01%, that's like, oh my God, that's way too low. So,
yeah. And that account that we have with Union Bank is really used to put the money there when we're actually investing, because they're the custodian of where we send the money to invest, and then our investment managers use that money to then put the money into different investments. So our main focus is safety, and then liquidity, and then yield. So we may not have a big yield, or the interest rates is really low at Union Bank, and that's why we're putting more money into LAIF, which has a better interest rate. But we have to use those money market mechanisms to have cash on hand. We don't really keep a lot of money with our bank, Chase. That's really the bank that we use to pay all our bills from, like payroll and our weekly bills that we pay our vendors. So our investments is where we get a better yield, but they're still restricted to what we can, because we have to have a balance of of the different types of investments. And our policy says we can only have a certain percentage. So we have to balance it out between the different investment tools that we have.
And when Eva mentioned that we don't keep a lot of money in JP Morgan Chase, if you see that it says here there was $12 million, that was just temporary until the money was moved to Union Bank to be invested.
Oh, okay.
But that's not normal to have such a high balance like that.
Yeah, we got our property taxes that month, so.
Right.
That's when we get a big check.
And this is in addition to our reserves, right? This investment, or is it counted into? It is part of our reserves.
Because this is all the funds within the city's money, all combined.
Okay.
Thank you.
Awesome. Thank you. We can go to public comment if somebody has questions.
We don't have anyone in the audience of public.
All right. Well, then we can move to pass this. And this goes back to council as well?
Yes, it'll go to council tomorrow. for approval.
So, Sridhar, do you want to move it? 5.2?
Yes, I move the item 5.2.
All right, and I can second that this goes to City Council for review.
Vice Chair Veros.
Yes.
And Chair Zafar.
Yes.
Thank you. That motion passes.
Thank you. Thank you, Candace. Thank you, Eva.
Thank you.
Thank you.
Item 5.3, California Employers Retiree Benefit Statement for the period ending December 31st, 2020. Verbal report by Candace Daniels, Finance Division Manager.
Thank you. So once again, I'm back just presenting the quarterly statement for the California Employees Retirement Benefit Trust, or the SERFD as we call it. So we started off with 34.1 million. We had investment earnings of 2.8 million. The combined fees total about $7,500 for an ending balance of 37 million. So this trust is for our other post-employment benefits for retirees. And we started this many years ago. So at this point, I believe we're approximately 95% funded. Isn't that right, Eva?
Yeah, per the last actuary, yes.
Right, so we're doing really well. We were up to 100% funded, but after the last actuary came out, it changed the number. So we're not quite 100%, but 95 is really great, especially compared to other cities. So we have budgeted this year to send an additional $300,000 to the trust before the end of the fiscal year. Are there any questions?
Councilmember Veros?
You're muted.
Oh, yeah.
You're muted.
So is this retirement health, or is it everything, including everything? Like
it's the health.
It's only health, right? That's the one which we are with 95%. Yeah, that's good.
And we call it OPEB. So you'll hear us say OPEB a lot. The other post-employment benefits, that's the acronym for that.
Oh, okay. OPEB. Thanks. Still learning some of this.
A lot.
Sounds
Candace,
good.
what was the actual reason that it went from 100% to 95?
Well, they do an actuarial evaluation every other year. So in 2020, we had to do the evaluation, and it's based upon the number of retirees and different factors that go into it. So at that point, the number decreased, and we were only 95% funded based upon what we had in the trust. So we could do another actuarial evaluation, which is due every other year, and the numbers will change then as well. It doesn't necessarily mean we'll be less funded, we could be more funded. So it changes every time. And we haven't been under 90% funded in several years.
Yeah, and I think the other reason too was that we were actually more than 100% funded. So when you get to a certain point, and we can still do it now at 95%, that we pay ourselves back. So we were making withdrawals to pay ourselves back for the money that we've been spending on retiree health. And that reduced the number down too. And so we kind of stopped doing that because we didn't want to start pulling from it instead until we get to a certain point, like more than 100%. But this trust fund is for us to use to offset some of our cost.
Okay. Do we look at it as in the number of years that 95% means we're funded for the next 30 years or something like that, or we don't look at that?
It's based upon what our liability is, and based upon the liability, we're about at the 95% point of the funds that we have, the assets that we have in the trust.
Okay.
Yeah, we're hoping that in future actuaries will show, because this benefit we had, a few years ago reduced the benefit, because at one point in time, people that worked here for a certain amount of time was funded like 100%, and then we changed it to they had to work 20 years before they can get medical. Now, new hires, we eliminated that benefit. So That should reduce the cost factor. So, but it'll take some time before we really see those numbers change where it start going down instead of up.
Okay, so that means new hires, once they retire, will not get medical benefits?
No, we set up a retirement health savings account for them that put aside for them and for an ICMA account. So they will have funding to pay their own medical, but they won't have that full 100% benefit like we had before.
Yeah, because theirs is 3% of their salary.
Mm-hmm. Thank you. I don't have any other questions, and I guess we have no participants.
And this was just a verbal report for information only.
Yeah, thank you. Appreciate it. Mm-hmm. All right, so that was just a report. Do we need to take a vote on it? Or? All right. On to the next item, 5.4, Perez Pension Stabilization Trust for the period ending December 31st, 2020. Verbal report by Candace Daniels, Finance Division Manager again.
Okay, so this is the statement for the Perez Trust. It's a trust that we created to offset the rising pension costs. So now we started at the beginning of December at 4.7 million. We actually had earnings this time because last quarter we suffered a loss. We had expenses of about 3,100 and we're ending at 4.8 million. So we haven't made, we don't have anything else budgeted for the remaining of the fiscal year. The last amount that we put in the trust was 1.5 million that has been completely invested in the trust. We initially put it in a money market so we can gradually invest it based upon how the market was doing. And we made the last investment sometime in December from the money market into the portfolio. Are there any questions on this trust?
Councilmember
what is the
Burrows,
total? Yeah, sorry. What is the total value of the the trust? Is it 4.8 million? That's right. Current.
That's correct. That's the ending balance as of December
2020. Mm-hmm. Okay. Sounds
correct.
And this is used when we have gaps in our pension. Is that why it's called the pension stabilization? Or
that's what we started it for. We haven't taken any money out though. So far, we haven't needed to do that. And the plan is to keep growing it until we actually do have to use it sometime in the future.
Sounds good. So what is a big difference between the California parts that California for when we are funding to CalPERS versus the trust fund? Is like the returns, is it like really good that this makes more sense for us, or?
Well, it's an option to do just to have some funds set aside. If we get into a budget year where things are more tight, then we know we have funds here we can draw down to actually pay the pension cost. Okay. But we're still paying CalPERS on a regular basis. And like I said, we haven't withdrawn any money from the trust to date.
Okay. So it's a must that we have to pay CalPERS, but we cannot just put everything in the trust itself.
No, we have to pay CalPERS.
We have to pay CalPERS. Okay.
So if I can just jump in here, so the CalPERS is what most of the cities have for their retirement systems, and so all the cities pay into the CalPERS system for their employees' retirement. And you're going to hear this a lot in the council world of underfunded and the funding levels of CalPERS. And that's all the different cities. And some cities are really underfunded, and other cities are better funded. And that's basically our contributions to the CalPERS system to keep our pensions stable. Well, it all depends on the investments CalPERS makes. It all depends on the discount rate that they determine that creates this unfunded liability. So we have an unfunded liability. That's money that we owe CalPERS. All the other cities do too. For instance, I believe our funding level is in the low 80%. Is that right? So
yeah, I think it's 83 to 85.
So that's about 85% were funded. We used a long time ago, we borrowed money and used a pension, was that a pension? Obligation bond, thank you, to pay down our obligations to CalPERS. But because of the fluctuation and how they do their investing and how they determine their discount rate, it creates an additional liability for us. And I think we're in the tune of 30 million, I think, somewhere in there, for the liability left. So when we made a decision to make the, create this other trust, this pension stabilization trust, we decided a couple years ago that we want to put some money aside. And there's two ways you can look at it. We could have taken all that money and just paid down our pension liability, right? But we're also it's really important that we stabilize our annual budgets, right? So if we happen to get hit with a large payment because of the way PERS changed the discount rate or some other mechanism and creates an increase to our pension costs on an annual basis, we already put money in annually, but if that has a significant increase, we wanted to have the ability to offset that, because that could be $1 million, $2 million just at a decision that PERS makes that would negatively impact our budget for that year. So by having this, you call it a savings account, we can now project through the next several budget years. If we do get hit with something like that, we're able to draw from that account and use it for our annual payments. But at any time we want, at any time, we could use that money and literally also pay down our liability. But because we make money on that as well, interests on that as well, it's a way to have that money, have it flexible and be able to use it annually, and set yourself up to give us a buffer against all these different potential negative budgetary impacts on an annual basis.
That's good. Thanks, Jim.
I think I'm good. Have no questions.
Okay.
Nobody in the audience, I guess. And so that was a verbal report as well.
Yes.
Any other comments, Councilmember Burrows, from you?
No, I'm good. Thank you.
Which was item number 6, committee member comments.
Oh, okay. So I don't have any comments. Thank you.
Okay. Well, this has been a fun meeting, chairing it for the first time here in the Finance Committee, but I've really enjoyed learning a lot. Thank you so much. We've been hearing all these things, but actually being able to sit and get some details, appreciate that. And, really thank you for leading this, Ava and Candice, and making sure, our financials are in a good position. Right now, most of the cities are complaining about their financial situation, what's going on over there. And I think we're in a good position right now. So cities' finances are not going down the drain.
Thanks for all the great work.
Yeah. So we adjourn for the next finance meeting till February 22nd, 2021. All in favor?
John, thank you.
Thank you.
Good evening, everyone. Bye.
All right, I'll see you on the next one.